On February 4th, 2026, Scott Bessent, speaking as U.S. Treasury Secretary, was asked a deceptively simple question. Does Donald Trump have the authority to remove Federal Reserve officials over policy disputes? Bessent replied that he had no opinion. There was no follow-up clarification, no reaffirmation of Federal Reserve independence, and no visible market panic. U.S. Treasury yields barely moved. Equity markets closed without drama. The comment passed as routine Washington ambiguity. But this moment matters precisely because it involved who said it, what was asked, and what was not said. For decades, U.S. financial credibility has rested on an unwritten rule that the Federal Reserve operates beyond direct presidential control. That rule has survived crises, wars, and political turnover, not because it was legally untouchable, but because senior officials consistently defended it. This time, they didn't. The risk is not that President Trump is about to fire Fed officials. The risk is that the boundary once treated as settled is now treated as negotiable. And once a boundary becomes negotiable, markets, institutions, and foreign governments begin adjusting long before any action occurs. Most observers instinctively look for danger in visible actions, executive orders, court rulings, or a dramatic confrontation between the White House and the Fed chair, Jerome Powell. None of that happened here. That's why the comment was easy to dismiss. But institutional credibility doesn't break through spectacle. It erodes through permission structures. By declining to state whether the president can remove Fed officials, the Treasury Secretary implicitly allowed that possibility to remain open. Not confirmed, not denied, simply unresolved. In financial systems, unresolved authority questions are rarely neutral. They introduce optionality, space for future pressure to operate. Investors don't wait for rules to change. They adjust when they believe rules might change. Central bank independence functions not because it is constantly enforced, but because it is assumed. When assumption weakens, behavior shifts incrementally. Lenders demand slightly more compensation. Corporations shorten planning horizons. Foreign reserve managers diversify just a bit more. No single actor causes this shift. Each responds rationally to perceived uncertainty. This is how institutional stress begins, not with confrontation between Trump and the Federal Reserve, but with quiet recalculation across thousands of decision makers who no longer treat the boundary as absolute. The United States' global financial position rests on more than economic size. It rests on confidence that its institutions continue to function predictably, even under political strain. The Federal Reserve sits at the center of that confidence. When senior officials decline to reaffirm the Fed's independence, the consequences extend well beyond Washington. U.S. government borrowing becomes marginally more expensive as investors price in institutional risk. Corporations become more cautious about long-term investment, uncertain whether monetary policy could become entangled with electoral cycles. Households feel this indirectly through financing costs that stay higher for longer or inflation that takes longer to settle. Internationally, the signal matters even more. U.S. allies coordinate trade, sanctions, and defense policy, assuming U.S. monetary leadership is stable. Strategic rivals, China, Russia, and others, do not need U.S. institutions to weaken. They only need ambiguity to constrain U.S. policy freedom. What makes this moment especially significant is timing. Between 2026 and 2027, the United States faces overlapping pressures: high federal debt, demographic aging, geopolitical competition, and repeated election cycles. In such conditions, political incentives to test institutional boundaries intensify regardless of administration. Once the question of presidential authority over the Federal Reserve has been publicly raised by figures inside the administration, it does not disappear. It becomes part of the background structure of governance. This is why the issue is systemic, not because it guarantees interference, but because it changes what future actors believe is possible. Financial systems are built on shared expectations about what leaders will not do. When those expectations weaken, the system adapts, not by collapsing, but by becoming more cautious, more expensive, and less forgiving. That adaptation is slow. It rarely trends on social media. But by the time it becomes visible, restoring lost credibility is far more difficult than preserving it would have been. What gives this issue its weight is not any single statement by Donald Trump, nor the personal views of any one Treasury Secretary or Federal Reserve official. The pressure point exists because of a set of invisible structures, economic, political, and institutional, that interact quietly beneath the surface. These structures do not respond to intentions. They respond to incentives, uncertainty, and precedent. At the center is the Federal Reserve, not as a building or a committee, but as a coordinating signal. For decades, the Fed has acted as a stabilizing reference point for millions of independent decisions. Banks lend, companies invest, households borrow, and foreign governments hold dollars based on an assumption that U.S. monetary policy will prioritize inflation control and financial stability over short-term political objectives. That assumption lowers costs across the entire system. It reduces the interest the U.S. government must pay on its debt. It allows corporations to plan years ahead. It gives the dollar an advantage no competitor can easily replicate. What threatens this structure is not overt control, but optional uncertainty. Once market participants believe that executive authority over the Fed might expand under certain political conditions, they begin to hedge. Hedging does not look like panic. It looks like modest adjustments, demanding slightly higher yields on long-term treasuries, shortening the duration of bond portfolios, or diversifying reserves into other currencies or assets. Each decision is small. Collectively, they alter the system's cost structure. This interacts directly with U.S. debt dynamics. The United States carries a historically high debt load, not because it cannot pay, but because it has been able to borrow cheaply. Even a small, persistent increase in borrowing costs compounds rapidly when rolled across trillions of dollars. That, in turn, creates political pressure to maintain accommodative financial conditions, reinforcing the very cycle that introduced uncertainty in the first place. This is the first feedback loop: perceived political pressure, higher borrowing costs, stronger political incentive to influence monetary conditions. A second structure operates through inflation expectations. Inflation is not only driven by supply and demand, it is shaped by belief. When households and firms trust that the central bank will act decisively if prices rise, they behave in ways that limit price increases. Workers moderate wage demands. Firms delay price hikes. Lenders accept lower inflation risk premiums. If that trust weakens, behavior changes subtly. Firms become quicker to pass on costs. Workers seek stronger wage protection. Lenders demand more compensation. Inflation does not surge immediately, but it becomes harder to bring back down without more aggressive action later. This creates the risk of sharper economic slowdowns following periods of delayed response. Here again, no single decision triggers the outcome. The structure responds to expectations, not announcements. A third invisible structure involves corporate incentives. Large firms, financial institutions, and asset managers often benefit from looser monetary conditions in the short run. Rising asset prices and cheap credit feel supportive. This can create a temporary alignment between political pressure and market complacency. But that alignment is unstable. Corporations plan investments, hiring, and research on multi-year horizons. If monetary policy becomes perceived as politically contingent, long-term projects become riskier. Firms respond not by exiting the U.S. economy, but by favoring shorter payback periods and more defensive strategies. Innovation slows at the margin. Productivity gains become harder to sustain. The cost shows up later in slower wage growth and fewer high-quality job pathways. The fourth structure is international. U.S. allies do not merely follow American leadership, they price it. Trade agreements, defense procurement, sanctions coordination, and reserve management all assume U.S. financial predictability. When ambiguity increases, allies quietly build safeguards, contractual exit clauses, diversified funding sources, parallel institutions. These are rational adaptations, not acts of defiance. But once built, they reduce reliance on U.S. systems. That reduces American leverage during crises, even if relations remain formally intact. Rivals understand this dynamic. They do not need the Fed to lose independence. They benefit if U.S. policymakers must constantly weigh market reaction when pursuing strategic goals. Ambiguity constrains action more effectively than confrontation. Finally, there's the precedent structure. Once the question of presidential authority over the Fed has been publicly entertained by senior officials, it becomes part of the political toolkit. Future administrations facing recession, unemployment, or market stress will remember that the boundary was once treated as flexible. Institutions are shaped less by written rules than by remembered behavior. None of this implies inevitability. The system can stabilize, boundaries can be reaffirmed, credibility can be restored through consistent action. But invisible structures are slow to rebuild once they have adjusted. Markets and institutions are cautious learners. They require repeated confirmation, not one statement to reverse course. This is why the issue matters even in the absence of drama. The real impact is not a sudden break, but a gradual reconfiguration of expectations, one that makes the U.S. financial system more expensive, more cautious, and less forgiving of future mistakes. And because that reconfiguration happens quietly, it is easy to underestimate until its effects are already embedded. Escalation in this case does not begin with a dramatic act. It begins with permission, the permission for uncertainty to exist where clarity once did. What follows is not a straight line, but a ladder, each rung modest on its own, yet collectively capable of lifting the system into a more fragile state. Rung 1, ambiguity becomes normalized. The first step is already visible. Senior officials decline to clearly restate limits on presidential authority over the Federal Reserve. Statements are carefully worded, legally cautious, and politically neutral. No rule is changed, no official is removed. At this stage, most observers dismiss the issue as theoretical. Markets largely ignore it because nothing tangible has occurred. But the normalization of ambiguity is itself an escalation. What was once unthinkable becomes discussable. What was once assumed becomes conditional. This rung matters because institutions rely on shared expectations more than enforcement. Once expectations soften, behavior adjusts even if policy does not. Rung 2, market hedging replaces trust. As ambiguity persists, financial actors begin to hedge, not against a specific decision, but against a range of possible futures. Bond investors shorten maturities. Long-term yields creep upward relative to short-term rates. Foreign reserve managers quietly rebalance a fraction of holdings. None of this looks dramatic. No capital flight occurs. The dollar remains dominant, but the system becomes slightly more expensive to operate. The U.S. Treasury pays a bit more to borrow. Mortgage rates remain elevated longer than models predict. Corporate financing becomes more selective. This is not punishment, it is risk management. At this rung, policymakers may misread signals. Higher yields can be attributed to growth optimism or global conditions. The institutional dimension remains invisible, which makes corrective action less urgent. Rung 3, political incentives intensify. As borrowing costs rise and growth slows modestly, political pressure increases. Elected officials face constituencies dealing with higher living costs and tighter credit. The temptation grows to view monetary policy not as a stabilizing constraint, but as a lever that could ease near-term pain. Here, escalation does not require explicit orders. It can take the form of investigations, public criticism, or selective legal arguments about executive authority. Each action is framed as oversight, accountability, or efficiency. The key shift is psychological. Monetary policy becomes part of ordinary political contestation. This rung is dangerous because it blurs roles. Once blurred, restoring separation requires more than silence. It requires visible restraint. Rung 4, institutional friction becomes public. At this stage, tension moves from inference to observation. Court cases, congressional hearings, or public disputes between the White House and the Fed chair, currently Jerome Powell, bring the issue into mainstream awareness. Markets still do not panic, but volatility increases around economic data releases. Every inflation print, every jobs report, every Fed speech is reinterpreted through a political lens. Foreign governments begin asking different questions, not about U.S. intentions, but about U.S. constraints. Allies plan contingencies, rivals probe for hesitation. The system remains functional but less resilient. Shocks that would once have been absorbed now transmit further. Rung 5, policy delay and overcorrection. If political pressure contributes, even marginally, to delayed monetary tightening during an inflationary phase, the eventual correction tends to be sharper. History shows that late action often requires stronger action later. At this rung, escalation produces its first clear economic cost. Growth slows abruptly. Unemployment ticks upward. Asset prices reprice. Critics then point to the downturn as evidence that the Fed mismanaged policy, fueling further pressure. This is the trap. The institution is blamed both for acting too late and for acting too forcefully once it does. The latter becomes self-reinforcing. Rung 6, precedent solidifies. Once a president, whether Donald Trump or any successor, has openly tested the boundaries of Fed independence, future administrations inherit the precedent. They need not repeat the action. They only need to remember it is possible. At this rung, the issue transcends personalities. It becomes structural. Market participants adjust permanently. Risk premiums no longer assume full insulation. Long-term planning incorporates political cycles as a variable. The U.S. still functions as a financial anchor, but with less margin for error. Rung 7, international spillover. As ambiguity persists, international systems adapt. Allies embed protective clauses into trade agreements. Multilateral institutions diversify leadership and funding. Strategic competitors exploit hesitation to advance their interests incrementally. No one announces a break with the U.S.-led order. They simply stop relying on it exclusively. This reduces American leverage not through loss of power, but through dilution of centrality. Rung 8, crisis as catalyst. A future shock, financial, geopolitical, or environmental, forces rapid decision-making. In that moment, any perception that monetary policy is politically constrained magnifies fear. Markets move faster. Coordination becomes harder. The cost of restoring confidence rises sharply. Importantly, the crisis does not need to be caused by Fed interference. It only needs to occur after credibility has thinned. Escalation here is not about intent. It is about structure. Each rung appears survivable. Each step feels reversible, but the ladder is climbed through inaction as much as action. The critical insight is this: institutions rarely fail because someone breaks them. They weaken because too many people learn they might bend. That learning process is slow, rational, and largely invisible until the system is asked to bear weight it once handled easily. This is why early ambiguity matters, not because it guarantees escalation, but because it makes escalation easier the next time pressure rises. And in a system as large as the United States, even small shifts in expectation can move history quietly and at scale. History rarely repeats the same events, but it often repeats the same structures. The closest parallel inside the United States is the early 1970s, when Richard Nixon exerted sustained pressure on the Federal Reserve under Chair Arthur Burns. At the time, there was no public announcement that the Fed had lost its independence. Rates were adjusted quietly. Growth looked strong. Markets were calm. The political payoff came first. The economic cost arrived later through entrenched inflation that took years of painful tightening to unwind. What looks similar today is not the policy outcome, but the logic. Short-term political incentives colliding with long-term monetary credibility. What is different is scale. The modern U.S. economy is far more globalized, more leveraged, and more central to the world's financial plumbing. Small credibility shifts now travel faster and further. Another mirror often cited is Turkey under Recep Tayyip Erdogan, where political intervention in monetary policy led to visible currency collapse. But this analogy is imperfect. The United States is not Turkey. It issues the world's reserve currency, commands deep capital markets, and retains stronger institutions. The danger is not sudden collapse. It is slow degradation masked by resilience. A more subtle parallel lies with the United Kingdom in the mid-1970s, when institutional credibility eroded gradually until markets abruptly demanded discipline through higher borrowing costs and external constraints. The warning from that episode is not about failure, but about timing. By the time consequences become undeniable, options are fewer and costs are higher. They are imperfect because the United States has more buffers than any historical case. But buffers delay consequences. They do not eliminate them. And delay is what makes the risk easier to dismiss. For most people, this issue never announces itself as central bank independence. It arrives indirectly, disguised as inconvenience, caution, or lost momentum. For middle-income households, the first signal is often cost of living that stabilizes more slowly than expected. Prices rise, then plateau, but don't meaningfully fall. Wages catch up unevenly. Planning becomes harder, not because of crisis, but because margins shrink. For retirees, the impact is quieter but sharper. Fixed incomes lose purchasing power gradually. Market swings make withdrawal decisions more stressful. What once felt like a conservative, stable plan begins to require constant adjustment. Small businesses experience the issue through financing. Credit remains available, but terms tighten. Expansion plans are delayed. Hiring becomes cautious. Owners respond rationally by protecting cash rather than taking risk. Growth slows not because of demand collapse, but because confidence thins. For younger workers, the cost is opportunity. Entry-level hiring becomes more selective during periods of uncertainty. Training budgets are trimmed first. Career paths stretch longer before stabilizing. The effects compound over time. Lower starting wages, slower advancement, delayed asset accumulation. None of this feels dramatic. That is precisely why it is powerful. When monetary credibility weakens, even slightly, the economy does not stop functioning. It becomes less forgiving. Mistakes cost more. Timing matters more. Safety nets feel thinner. The impact is not evenly distributed. Those with assets and flexibility adapt. Those dependent on wages, fixed incomes, or predictable credit feel the strain first. This is how institutional issues become personal. not through headlines, but through the slow narrowing of room to maneuver. The most unsettling aspect of this issue is not what has happened, but what has become thinkable. Once the idea of presidential authority over the Federal Reserve enters mainstream discussion, without clear rejection, it does not need to be acted upon to matter. It lingers. It waits for stress. It becomes available when future leaders face recession, unemployment, or market panic. At that point, the question will not be whether intervention is wise or reckless. It will be whether restraint is politically tolerable. Financial systems are built on expectations about limits, about lines that will not be crossed even when pressure rises. When those limits blur, every future decision carries more weight, more suspicion, and more cost. The danger is not authoritarian control or sudden collapse. The danger is a system that becomes permanently cautious, more expensive to operate, slower to recover, and less capable of absorbing shocks. And the hardest part is this: nothing forces a correction early. Markets adapt, institutions adjust, people cope. Until one day, a crisis arrives that demands clarity and discovers it is no longer fully available. This is not a prediction. It is a structural risk, one that grows quietly, feeds on ambiguity, and reveals itself only when tested. The question facing the United States between 2026 and 2027 is not whether its institutions will fail. It is whether they will remain strong enough to be trusted without constant proof. If you want to understand where power is really shifting in the global system, don't watch the loud confrontations. Watch the boundaries people stop defending. If this analysis helped you see a familiar issue differently, consider subscribing or sharing it, not for alarm, but for clarity. Because in geopolitics and markets alike, the most consequential changes are often the ones that arrive without noise.